Just a reminder that the meeting is being recorded to all that are on the call. If anyone would like to sign up for public comment, please sign up on the chat with your name and the words public comment. If you do require any kind of follow-up, please be sure to send your email address to me, which is listed on the agenda.
All right, Pamela, I think we're missing John Heiler.
Correct, but we have a quorum.
We have a quorum, right?
Mm-hmm.
All right, so let's get started. Good morning, everyone.
Good morning.
All right, so I will commence with my opening statement so that we can do a roll call. So the trustees of the Boston Public Library reaffirm our commitment to racial equity and to principles of diversity, equity, and inclusion more broadly. The library is formally committed to becoming an anti-racist organization in response to systemic racism, inequity, and injustice prevalent in our society. We acknowledge also that the Boston Public Library's Central Library stands on land that was once water-based ecosystem, providing sustenance for the indigenous Massachusetts people, and is a place which has long served as a site of meeting and exchange among nations. We are committed to land acknowledgements for all locations at which we operate. We reaffirm this commitment to set the context for our planning, deliberations, and public engagement will take place from the spirit of welcome and respect found in our motto, free to all. All right, with that, we have an exciting meeting, lots of contracts and portfolio to review. Ms. Pamela, can we please have a roll call?
Yes. Arana Ortiz.
Yes.
Arenas.
Here.
Val.
Present.
Tyler. Leonard.
Here.
Rush.
Good morning.
Thank you.
All right, all set. All right.
Sorry.
No, that's okay. Next in the agenda is review and approval of the minutes. Can I please get a motion? These are for September 21st. I'm hoping everybody had a chance to review. Can I please
Moved.
back in?
Second.
Thank you. Roll call, Pamela?
Arana Ortiz.
Yes.
Arenas.
Yes.
Val.
Yes.
Tyler. Leonard.
Yes.
Rush.
Yes.
Thank you.
All right, thank you so much. All right, so now we're gonna review, we have a couple contracts to review. So David, are you gonna be reviewing the contracts on behalf of Ellen?
I am. She has provided me in advance the necessary commentary. So the first contract is a vote to approve contract with City Mail. They are a bulk mailing service, and we have found over the last several months the necessity of returning to old school marketing. And so we did a postcard mailing for the Roxbury ribbon cutting, and we'll plan to do potentially the same for Rosendale as well. So this is a blanket contract to cover those costs. Postage is included, and the bulk of the fees are actually postage related, which technically isn't required to go to bid. But in this context, we believed we'd prefer to have trustee approval for a blanket contract with the selected vendor of City Mail.
Okay.
Do you want me to do them all together, or?
Well, actually, why don't I open one per question?
Okay.
Anybody has questions about bulk mailing services, 20,000. So let me ask you a question. That's not just for Rosendale, that is just bulk mailing.
Yeah, the cost of the Roxbury mailing was about $12,000, but that included the postage as well.
Uh-huh.
So
this is only specific for Rosendale and some other thing, or?
Yeah. I mean, at this point in time, we're planning to do some for Rosendale, but also, and we may come back to you on this in the new year. Lisa and the team believes, we really will need a campaign next year, basically to continue the process of welcoming patrons back to the library, reminding them that we're open and what our services are. So, I think we all understand that, there was a large pivot to online activity, both during COVID and post-COVID, but that leaves a whole slew of the population out that we need to revisit as well. I think we're proposing that the Rosendale costs will only be about $5,000. So the $20,000 amount here gives us approval to cover anticipated costs.
Okay, got it. That's what I was trying to figure out what was the scope. And it's Rosendale and any other future mailings that we need to do for the next, through the end of the fiscal year, I'm guessing.
Correct.
Okay. All right. Any more questions? No?
Can I just ask David, so there was an RFP process for this? Am I understanding that right?
We are not required to do an RFP process as it's under the cap for an RFP.
Okay.
All right, so I'll just do the votes later one by one. I think it'll go faster. All right, next one.
The second contract here is seeking approval for an expenditure not to exceed $30,000 for we are basically, because let me back up a second, because at this time of year we generally do our full-on staff appreciation event, which is an in-person event with food and drink, and we're not really able to do that yet at the scale we would normally have done. And so this year we are choosing to basically gift an item of clothing to all of our staff, a fleece, not technically a fleece, a vest, a pullover, and we've selected a style. There are 3 style staff get to choose from, and that's just one way in which we are expressing as an institution our appreciation for staff. This was actually one of several suggestions that came from staff that they would like and appreciate themselves. We did solicit quotes from 3 vendors, and the one before you is the one offering most value.
Okay.
Um,
Any questions around that contract?
Not directly on the contract. I think it's a great idea to do this for staff. Will this also be part of like a virtual celebration with staff and recognition for their years of service?
Yes, we're doing multiple smaller things that together we hope add up to the equivalent of what the full in-person event would have been. We had a breakfast recently for mostly for central staff, but all staff were welcome under the Celtics banners that are hanging in the DeFerrari hall right now as an exhibition. We're providing some funds for branch staff to do their own local little breakfast that if they were unable to come. We're also going to do a virtual meeting for staff appreciation, and that will be in December, and we'll keep the trustees apprised of that. Certainly, that will at least include those who hit our 25. I don't think we have any 50-year milestone staff this year, but we will certainly be doing that and other ways to recognize staff as a whole. So this is one part of a series of smaller events.
Great, thank you.
And the next one, manager and tools.
Yeah, and I'm going to actually ask Michael to join us to talk about this. This is a part of our commitment to increasing training for all staff, but this one is specifically for new managers and new supervisors. Michael?
Sure. Thanks, David. Good morning, trustees. So this training was given to the IT supervisors by the previous CTO, Kurt Mansberger, and they gave a report to leadership on what they had learned, and it seemed like a really great opportunity to use this company to train other supervisors. We do a lot of management training, but we don't do a lot of supervisory training. So this is a really great opportunity to provide some training for, as David mentioned, the supervisors who are not technically managers, but also some of our newer managers as well. It really focuses on a lot of the relationship management that supervisors have to do with their departments. So we're going to be having trainings to serve upwards of 40 people. They do a nice training they can do a nice training specifically for the library up to 30 people. So we'll probably have to do this in two groups.
And again, this is a not to exceed contract. We think the current scope that we're in dialogue with the firm on is probably more like in the 15 to 20K range. Although we can certainly increase that to 2 groups, as Michael has suggested. So those are our narratives for the 3 votes that are before you.
Hey, Michael. When we say supervisors, we're saying supervisors regardless if they are librarians versus operations versus, right?
That's right. That's right. Yeah, we have a lot of supervisors who are also in the 2 unions and are that oversee various departments. So we're trying to get them some training as well.
Yeah, typically every branch has a branch librarian and a library assistant supervisor with the ability for others on the team to step in. And so, if this is successful with the first batch of people, there will be a lot more than the 30 that really ought to go through the same kind of training.
Yeah, no, the reason I ask is because this has been on Alyssa's always, the training box. I just want to make sure that I think it's great for new managers. People get promoted through the ranks and, having that skill set, it's a good start. Just want to make sure that it's across the board.
Yeah, most of these people, Evelyn, are not managers, most of the people in this group. And I am working with Alyssa. She's going to help me roll this out.
Excellent. Beautiful. Any more questions?
You asked my question, Evelyn.
What? I asked you. All right. Any concerns, any more questions on these 3 contracts?
It's not about any one of these 3 contracts. I'm no questions about them, but just in general, at some point, it doesn't have to be today, it would be helpful to get sort of a understanding of the criteria that the library uses in doing these contracts that are below, like where you have to RFP. And particularly, I'm thinking about focusing on minority-owned companies, women-owned companies, that kind of thing. Again, nothing to do with any of the contracts.
Yeah, I think that's great that we should do a recap on what the thresholds are for solicitation, for formal bidding, for full RFP, as well as looking at the criteria. Certainly, at least in the case, I believe, of the Brooks Custom Apparel contract, that is a minority and state certified business. So that's something we definitely pay attention to. And the city is rolling out a whole slate of requirements for more equitable under the banner of more equitable procurement. There are also state procurement rules that have to get balanced into that. So yeah, I'll talk with Ellen after this meeting about making that a main topic at maybe one of the next Finance and Audit Committee meetings.
That would be so helpful. Thank you.
Yeah, I mean, what I can tell you is that Ellen does a good job, telling many minority businesses are not registered. And then so encouraging them to register and giving them resources to that's something that they do because it's important. Like, otherwise, how do you know, right? So, but yeah, I think it's a good topic, for Yep, because we have new members in the committee to understand. I mean, we've been doing this, so we're just kind of like, yep, yep, yep. So we're happy to do that. So we'll put that on the agenda. All right, this is how I want to do this vote so I can be in compliance. We can't do the lot. So Pamela, if you can just call the first one, do the roll call, call the next one, do the roll call, and so forth.
Sure thing. If you want to just do your motion and then,
So I'm gonna do a motion.
Moved.
Second?
Second.
Roll call.
okay, roll call for the city mail. Arana Ortiz, Aranis,
Yes.
Val,
Yes.
Hyler. Sure if he's on. Leonard
Yes.
and Rush.
Yes.
For Brooks Custom Apparel, Arana Ortiz,
Yes.
Aranis,
Yes.
Val,
Yes.
Leonard
Yes.
and Rush.
Yes.
And for Manager Tools LLC, Arana Ortiz,
Yes.
Aranis,
Yes.
Val,
Yes.
Leonard
Yes.
and Rush.
Yes.
All set. Thank you.
Right. All right, Sebastian, you're on the docket. How good were
Good
you?
morning.
Good morning.
It's been a while. It's good seeing everyone.
No.
I just full disclosure, I have one of my sons at home. He has strep throat and he's in the other room watching cartoons. But if you see me quickly go to mute, that's the reason, because he's running in here to ask me a question. It's usually the best time to get what you want because you know I can't say no when I'm talking. So but I've definitely got some good news for you on your portfolio. It's been a banner year yet again. So I think for today, what we want to talk through is just giving you an update on where things stand from a performance perspective. We don't have numbers through October just yet, but October turned out to be an extremely strong month. So when you see the year-to-date numbers and the trailing numbers, October will simply add to that. We'll give you a quick market update on where things stand in preparation really for 2022 and beyond, which is when we typically review asset allocation. I don't imagine we'll be making recommendations for many changes. I think we're in a pretty good shape today with the asset allocation that we have in place. So the one thing we do have as a recommendation for you is just simply rebalancing. And that really ties back to some of the performance that we've seen throughout this year, but some of our changing views on some of the asset classes we have in the portfolio where we prefer to underweight them today. So if we go to page 2, really, we've laid this out as a review of performance for the year, what we're seeing today, and how that impacts our thinking on a go-forward basis. So there are a ton of numbers on this page, and I won't go through all of them. We've highlighted the year-to-date column. This is through October, just to show you what kind of returns we've been seeing across the board. If you look at the equity markets, which is the top table here, equity markets have been driven by the US, specifically large cap and small cap. So if you think back to the beginning of this year and really towards the tail end of last year, we started to see this excitement about the reopening of the economy, both here in the US and globally, as well as this reflationary trade, this trade of pent-up demand, this trade of people having had sat at home for the last year or so. Savings rates increased substantially and people were ready to get out there, spend. And that's what you're seeing here in terms of the impact of the market on the markets as a result of that, particularly on the small cap stocks, because those were more reflective of the more domestic oriented companies. On the fixed income side, one of the implications that we had as a result of this was this view that we're starting to see some pressures around inflation. Right, we're starting to see price increases in areas that were very depressed, and a lot of the terminology used throughout the summer was transitory. So, inflation on things like used cars. So, if you recall, post-pandemic, companies like Hertz and others simply sold their entire fleets of vehicles because they had no demand for these goods at that point. Demand came back a lot quicker than they expected, and they had fewer cars to sell, hence the price increases. Travel, leisure things, all of those pointed towards perhaps in the short term seeing some pressures on inflation, and as a result the market pulled back and rates increased as the market thought that we will see higher inflation, and we'll talk about that here in a second. And then the last part here, the last table, is what was really roaring this year, again, coming off of the lows of last year, which is energy. So oil prices, heat prices, natural gas prices. I feel like it's something that when you put on the news, there's an article or a story about it every day. You know, there's a shortage here, there's price increase there, et cetera. And, you know, anecdotally, I was grilling this weekend, I ran out of propane gas. I went to the gas station to replace the tank, and inflation hit you right away at the gas station, because over the last month or so, the replacement cost jumped up about $5 from 20 to $25. And it seems like it's a small shift, but if you kind of add that up across, you know, multiple items, you're definitely feeling it. So if we move to the next chart, I wanted to talk a little bit about what's happened in the markets, particularly in the third quarter, because a big news story, especially in September, was really China and what was happening in China from a performance perspective. So over the last year or so, the Chinese government has started to crack down on certain areas of their market, really thinking about companies who they feel have sort of grown or outgrown their original mission. And wanting to rein in any potential risks, not only to the government, but to their market economy or their economy as a whole. And that really came to a head in September when you saw the whole situation with Evergrande, which is a Chinese real estate developer, simply not being able to repay the interest on their debts. And there was a concern that China was going through their Lehman moment, like we went through back in 2008. Luckily, the company was able to sell some assets and make well on their payments. Unfortunately, the sell-off that ensued did impact performance of Chinese equities and the broader emerging markets as a whole. This is important because when we do talk about performance, you'll see that UBS, who is our emerging markets manager, while they've done well on an absolute basis, they weren't immune to some of the sell-off that ensued in Chinese equities. If we move to page 4, as I mentioned, with rates moving around a lot this year, you know, the thought about inflation, and we have a couple of slides here, which I'll touch on in just a moment, it was really front and center. There's a lot of information here, but really if you focus on those two middle lines, the yellow and the gray line, that's where we are today. Inflation is elevated. Rates are elevated. There's an anticipation that in the near term, we will see elevated inflation prints. You've heard from the Fed that as a countermeasure to that, they're going to start to taper their asset purchase program, which if you recall early on in COVID, we saw huge support both from a monetary and fiscal perspective, meaning that the Treasury and the Fed simply started to buy assets to help support the markets. And then from a congressional perspective, we saw fiscal policy, which was meant to support the citizens of the country. Well, now where we are well post that pressure that we had on the economy, looking forward, you know, the anticipation is that with the Fed tapering, we're going to start to see rates rise, especially on the short end of the curve. And there's an expectation that over the next year or so, that will happen. But the first step of that is the Fed slowing down their bond purchasing approach and really letting those assets start to roll off to reduce their balance sheet. If we move over to page 8, in a snapshot, this is what was happening from an inflationary perspective. So as I mentioned earlier this year, a lot of transitory pressures, right? So things that don't necessarily contribute a lot to the inflation print. So you see the light blue chart there, those are used vehicles. You see the sort of the darker blue bar, especially over that April timeframe, pandemic affected services. So things, like I said, leisure, hotels, travel, restaurants, things that were very much impacted the year prior. And then other things that make up your typical inflation. So you'll see that come July, that part of the print kind of leveled off because we saw a little bit of a normalization. But as we look forward on page 9, the question now is, has that transitory inflation moved a little bit towards stickier inflation, so stickier parts of the market, wages, rents, et cetera. And that's what we're looking at and focusing on now. Again, when we think about inflation over the long term, we feel like that 2% mark that the Fed is trying to hit is where we will get back to. But in the near term, there is the possibility for more elevated inflationary pressures. We want to make sure that from an asset allocation perspective, we're positioned in the correct way to take advantage of that type of a market situation, because inflation will have a different impact on the varying asset classes that we have in the portfolio, as each one has a slightly different inflation sensitivity. So from a strategic asset allocation perspective, a lot of this you've seen on page 10 from us before. We typically look at this from a thematic perspective at the beginning of each year. We build out themes that we think will last over the next number of years, the intermediate term, that we think will play out and have an impact on the market. Over the last few years, over the last few years, the 4 themes that we've had, they've evolved, but they've been the virus trajectory. Initially it was simply, we had the onset of the pandemic. There was really no treatment for it. We didn't know how quickly it would impact the globe and how quickly it would impact the global economy. Fast forward almost 2 years, that's still a theme for us. However, it's no longer as prevalent as it once was. Permanent interventions was this theme of the central banks around the globe continually either pumping in money into the system to support it or providing support in some other way. And today, as I just mentioned with my comments about the Fed, we're at the inflection point of providing support, starting to take a little bit of the support off because we're in a much better position. But yet, what the Fed does still has an impact on the market. So that's a fairly prevalent theme and plays into our strategic asset allocation outlook. The third theme was globalization backlash. This is an evolving theme. You're starting to see a little bit of the differences between those who benefited from everything that happened in the last year to those who are highly impacted and are still impacted, and really the unevenness there and how that plays out on a go-forward basis. And then the last one is China transitions. And initially, this was a theme that was really set in the evolution of China's economy, moving from a manufacturing economy to a more service-oriented economy. And those with that kind of a shift do come growing pains as you're trying to really reestablish yourself and the services that you provide. And now when we look at 2021, the more heavy hand, if you will, of the Chinese government on certain industries continues that evolution. So it's something that we just want to be mindful of. But from a strategic asset allocation perspective, we still see on a relative basis more opportunity in equity than in fixed income. So today, we recommend clients have a slight overweight to equity relative to fixed income on the whole. And currently the portfolio is positioned in that way. Within the equity markets, we think that the US provides a better opportunity than developed non-US. And developed non-US is simply Europe and Japan. And then even with what we've seen from China over the last couple of months, long-term, China is the second largest economy and will become a larger part of the global economy. So it's part of the market that we don't want to ignore. And we still feel like a market or a slight overweight to the market is appropriate, which is where we are today, or where we'll be recommending we get to today. However, we have to understand that that does come with a little bit of variability. So from a strategic perspective, we've positioned that as a smaller part of the overall asset allocation. And then the last piece here, or the last two pieces, we don't have direct real assets exposure. And really that's commodity-based real assets, things like that, because we have to think about it from a strategic perspective, what the purpose is. We have asset classes in the portfolio that have higher sensitivities to inflation. So they provide us what real assets would from a strategic perspective. For example, the PIMCO All Asset Fund has a built-in inflation beta into it, which should benefit from an increase in inflation. And other asset classes like large cap value also have a built-in inflation sensitivity because they invest in certain areas of the market that benefit from that type of a regime. So at the onset, I had mentioned, not a lot of changes with the exception of some rebalancing that we'll be recommending. And we can talk about that in a minute, but I'll stop there because I feel like I've said a lot and covered a whole lot of topics here before we move into the portfolio.
Questions? That was a lot.
Sorry.
Oh, no. I mean, it was needed. I just want to leave people to absorb and ask questions.
Yep, Sebastian, it sounds like the main real sort of indicator to pay attention to right now is the trajectory of inflation. And while that might be, annoying for our personal pocketbooks from a investment portfolio, it's actually not necessarily a negative strategy as long as we're positioned appropriately, and that's that's basically the basis of your recommendation today.
That's correct. And I think it's worth noting that, when we think about it from short term to long term, right? So in the short term, yes, there are pressures, and even areas that should have a higher sensitivity to inflation, meaning that they can perform better, may have a little bit of a shock in the near term, but over the long term, that normalizes. And in fact, those asset classes end up benefiting from it, right? Because they see a little bit of the growth. So you're absolutely right. And that's what we're trying to capture here with some of these recommendations.
And how, how much more above the 2.1% or 1.7% would you want to see that for a period of time before it starts to have more of a negative portfolio depressing effect than something that can be taken advantage of?
So the market right now is pricing in on average, right? So it's going to look at it at the yearly average, roughly a 3% inflation rate over the next, call it 1 to 5 years or so, before we start to see it dip back down to long-term averages. Because for all of the inflationary pressures we're seeing, there's also deflationary pressures that we're seeing. So demographics, for example, technology is a deflationary pressure because it actually causes more efficiency in the market, right? A computer or machine can do a lot more work more efficiently to drive down costs. So they're counteracting parts of this. I think for us, as we do go forward, how sticky is the inflation that we're seeing, and how prolonged do we see it? And that really ends up forcing the Fed's hands a little bit more, because if we see inflation prints that are higher than what we've been seeing or higher than is expected, that may require the Fed to react much quicker and in fact raise rates a bit higher to counteract that. And then that could lead to its own volatility and potential impact on the economy. So just going back to expectations and to the themes that I was talking about, the market believes that the market doesn't like surprises, right? The market wants to know that the Fed, if they're going to be tapering and they're going to be raising rates, that they want to hear that communication from them. And if it comes time and we're seeing the data points there that support that, there's an expectation that that happens. If we come to a point where either the Fed doesn't raise a rate when the market expects it, we can see a little bit of a pullback in the market. Or if the inputs that the Fed's using kind of run ahead of them, and they have to react quicker, that can have an impact on the market. So long-winded way of saying there, it's a little tough to say. If we're just if we're looking at what the market is giving us right now, there's an intermediate period where the market expects there to be elevated inflation before it sort of normalizes longer term.
And I didn't hear you reference any of the likely 1 or 2 very large federal Washington driven investment packages. Although the real economy doesn't necessarily it takes its time to absorb those. So just to comment on that, if you would.
Sure. Part of the bickering that you're seeing in Washington around these is the size. I guess if you look at it, whether it's $1 trillion or $2 trillion, it's spread out over 10 years, as a lot of these huge bills are. So at $2 trillion, it's $200 billion of added liquidity into the system. The concern from certain sides is that you're adding liquidity at a time that it's not necessary. And you're adding liquidity at a time where the market's seemingly doing pretty well. And we're seeing these pressures from the other side. So by adding more liquidity, you're actually increasing the potential for inflation to be prolonged. And that's sort of the concern there. And that's sort of the back and forth that you're seeing there. Obviously with the infrastructure package being passed, there were some thoughts around the benefits of that, whether that is clearly from an infrastructure perspective, that spending is necessary around the country. It's focused on newer technologies versus older technologies, so renewables, the like, et cetera. So I think there's definitely benefits that you're seeing from that. We'll see the secondary package where that falls, but we'll take that into account next year as well, or if they pass it this year, we'll still take it into account next year as we're looking at our themes and asset allocation assumptions, because that'll play out into what we're seeing on a go-forward basis.
Great, thank you.
Sebastian, I have to say, I was a little surprised to hear that, recommendation is to move a little bit more to equity, because and this is because I'm squeamish, I feel that the market is, and that's my opinion, not a
Mhm.
professional opinion. This is not what I do on a daily basis. But, this sense of with inflation maybe overvalued. And then, because for years, we've been talking in this meeting about, when is a bubble gonna burst? And then the fact that, recommendation is like, you know what? Doesn't seem like it's gonna burst anytime soon. Just carry on onto that path. So that was a little bit of surprise to me, but
Yep. And it's a great observation, right? It's one of those things where you have to, we look at it from a relative value perspective. And if you're going to put $1 into equities versus fixed income today, on the fixed income side, on a real basis, it's a negative return, right? If you include inflation, an inflation adjustment. On the equity side, while it's not as high as it once was, it's still a positive real return that we're seeing. So from an equity risk premium perspective, it favors equities in the short term. Longer term, if we continue to see the path of fixed income rates increase the way they are, especially if you get out to like the 10-year, et cetera, that's sort of your risk-free rate, right? So if you're starting to be paid pretty well to hold less risky assets, that starts to change the discussion around where does it make sense to have the asset allocation. For today, this rebalancing is more of a shorter term trend. It kind of gets us back in line to our targets. And even when within fixed income, we're actually on the whole increasing it a little bit. We're still below target, but we're focusing more on the safe haven assets, sort of the treasuries, the core bonds, the areas that are less credit centric, meaning that they're less susceptible to some of that volatility that we would see from the equity markets.
And you're not proposing a policy review or a policy change at this point, just paying attention to where the individual investments have ended up due to either over or slightly underperformance over the last year.
That's correct. Yep.
all right. Any more questions? Commentary. All right, so I'm guessing that the next thing you're gonna say move from here to there. You're on mute, Sebastian.
There it is. My son did not come in. I just forgot to take myself off mute. So the next thing I thought, if we turn just to page 14, just to give you a sense of where we were at the end of September here in terms of the numbers, because they were great. The portfolio performed and has performed and continues to perform extremely well. So if you're looking at the calendar year to date through September, 8.8%, the last 1 year period. So that's from last September through the end of September. We're up 23.5% and really double digits all the way out to 10 years. I mean, that's just phenomenal. Those returns are extremely strong on an absolute basis. And we have some peer analysis further in the book, which I won't go through, but if you look at it on a relative basis, relative to your peers, outstanding rankings as well. So, you're in your top quartile effectively in terms of the performance that has been achieved. And that's largely a reflection of a couple of things. Strategic asset allocation is one of them. So the shifts that we've made over the last 10 years, if not longer, have been timely and really have shifted the portfolio towards opportunities at the right time. It's not always the case. We have had some managers who have underperformed over time and we've eliminated them when we've needed to. But on the whole, we've seen that strategy work extremely well. Timing of new strategies into the portfolio, impacts being a perfect example. If you look at the since inception return, it's not a typo. They really have returned that much since inception. I believe it's over 40% since inception, 58%, excuse me, since inception through September. The timing of that was the perfect entry point into that strategy, as really a lot of the themes that they're looking to capture took off. So, that's the secondary piece of it. And the third is rebalancing. I think that's a discipline that most investors definitely take seriously, because you want to be able to take off the table from certain things that have outperformed and put them into areas that maybe have underperformed. You'll see in the rebalancing here, we are recommending adding a little bit to impacts, and it's not. It's more due to the fact that we're underweight to global equities, and impacts has been closed and recently reopened, so a little bit of capital. So it gives us an opportunity to bring that to target. But with the rest of the asset allocation recommendations, we'll talk through those in a second. So high level, great performance. Assets at this point are at about $76 million. When we do get the October numbers, we'll send those to you. However, based on everything that we've seen, we expect that we'll see an increase here, both from a performance and an asset perspective. When you look at the asset allocation at the bottom left-hand table, you'll see that we're not too far off from our targets. You know, it's really a couple of percent in either direction. We just want to bring those a little bit closer in line to those targets, so we can again equitize a little bit of the gains that we've seen from some of the strategies. And then you know, maybe we just go right to the next page actually, and we can just talk through the asset allocation here. But
I was, Sebastian, before you talk about this, I just want to give, well, first of all, Sebastian, you know, thank you for all the recommendations, but I'm also going to give big thanks to this committee because, you know, we have taken action to recommendations where in the past, you know, there was recommendations and nothing was done. So we have taken an active interest in the performance of the portfolio. And I'm so happy to see the returns in the past 10 years. So I want to give kudos to the committee for, you know, really, you know, taking action on the recommendations that Sebastian has provided. So, and I reap the benefits too, because the trust funds that we manage on the fellows, it's on an incredible balance and allows us to, you know, provide more, you know, more programming to the patrons of the library. So thank you all. Thank you, Sebastian.
not a problem. I did cut out there for a second, so I apologize if I dropped off.
No, you did not. You're fine.
Okay.
So let's talk about moving things around.
So sure. So it seems like a lot of moving parts here. For that, I apologize. I'm sure Sean, when he sees this, is going to yell at me when we talk later, but that's fine. We'll get this done. But really, as I mentioned at the onset, you know, we've had really strong gains from our equity managers. We've had really strong gains from our multi-asset managers. And when we initially put in some of these exposures, soon after we put the funds in, the managers closed to new assets. And that really provided us with a slight dilemma. And if we ever wanted to add to these funds, we wouldn't have been able to. And that's the case with Impacts and to an extent with UBS. But in talking to both managers, they are open now. They have a little bit of capacity. So we want to take advantage of that, because what it does is it allows us to get closer to those targets that we have set for them. So for Impacts, that's about 12%. For UBS, that's about 7%. So the recommendation there is to add $1 million a piece, and that would come from the large cap fund, the S&P 500 fund, and the small cap fund, Siegel Bryant, both of which have had a fantastic run here over the last year or so, if not longer. And that also allows us to really bring those strategies closer to target. And again, taking advantage of the market opportunities there. The fixed income piece is the one, Evelyn, that I had mentioned earlier, where we want to maintain fixed income exposure. Obviously, it has a role in the portfolio. And that is to make sure that we have liquidity, that we have safety assets in there. But within that, we also want to make sure that we have the right exposure in between the strategies that we've hired. So what you're seeing here is really similar theme, taking down the multi-sector credit exposure. So if you're kind of thinking about what multi-sector credit is, think high yield, think slightly higher return-seeking bonds that give you a higher yield, but are a little bit more risky than a simple treasury, right? Because they have to, in order to get that higher yield, go out a little bit on the risk spectrum. Manulife is highly diversified. They have a lot of levers to pull in this fund, so no real concern there. It's more of a overall market call on this one. So we want to take about $1 million from Manulife. And then to my point about tips or inflation earlier, you may say, well, you just told us inflation is on the way. Why do you want to reduce tips? If you look at the way tips work and where real yields are today, they're very much negative. And if we see the Fed move rates up, tips will be impacted more greatly than nominal bonds. So we want to just simply reduce and resize that allocation. And with those proceeds, along with PIMCO, we want to increase just nominal treasuries. That's sort of our ballast, our liquidity allocation. And the core bond manager, IRNM, similar story. They're a very conservative manager. They're not going out there seeking risk. They're very much down the middle in terms of how they're allocated. And what all these shifts end up doing is it actually positions the portfolio where we need it to be. So we're getting certain areas of the portfolio back to target. We're not significantly overweighting our equity allocation. We're actually providing the balance that we're looking for. And the same within fixed income. We're providing the balance that we're looking for between return seeking and safe haven assets.
So I understand the 9 transactions that you're proposing to do, but could you just square that with the desire to maintain holdings within equities that we said earlier? So you're basically here within the equity space moving about $2 million from US equities to non-US equities based upon the holdings. Could you just comment on that?
Sure. No, so that's a great point. The reason for the 2 million from the US equity market, so if we look at where we are today, that call it current weight and fund column, we're at about 33.5% in US equities. And if you're looking at the SRI S&P 500 fund, as well as the small cap fund, these are 2 strategies that have had extremely strong performance over the last year and are now significantly overweight relative to their targets. Further, there's a little bit of a growth tilt built into the S&P SRI fund. So again, we want to reduce that a little bit to balance what we have with Diamond Hill and the value manager that we have there. We're moving that to UBS and to impacts. One, UBS has been underweight for quite some time. And the addition here actually brings them to that target allocation, not only strategically that we want, but regionally that we want. So my comments earlier around if we're looking at just equity markets globally, if you're looking at a broad-based equity index, the MSCI ACWI, which is sort of the S&P 500 of the world, about 58% of that index is US equities, about 13% or so of that index is emerging equities, with the rest developed market equities. So if we're looking at that type of a benchmark, we want to be overweight with our exposure to US and emerging and underweight to our exposure to non-US. And by doing this type of move here, we're maintaining that and we're actually getting that emerging market exposure increase to where we want it to be. So there's a lot that goes on behind it that we can talk through.
Yeah, and honestly, without knowing the individual makeup of the current holdings, we need to go to that level of detail to just understand the risk. But maybe we could do that at a future meeting, because I think we want to pay attention to what companies and types of sectors we're actually end up in investing in anyway, even though our approach is to leave that to the managers.
Yep, and I think the key thing here is also on the impact strategies. If you remember, it's a global thematic strategy. It's more focused on really the new wave of technology. So think more renewables, think more focused on that type of infrastructure. And that actually adds and brings that strategy up to target when we look at it. So when you look at the last year's worth of performance for them, for example, what drove that? Things like solar power, things like Generac or generators, things like water utility and the infrastructure around that. So a lot of the things that we want to support, that strategy is investing in. So that allows us to do that as well here.
Yeah, not only is it a good ethical thing, but it's also good from a performance point of view. So win-win.
That's right.
So I have, I always ask this question and I should have it, but then I never remember. David and Pamela, I think we take a vote to rebalance and then we don't have to do a full trustee vote for this, right?
I believe that's correct. I think it's only in the case of a policy change, which in itself would also trigger a further rebalancing, that we go to the full board.
Okay. All right, so we don't have a vote on the agenda, but we can call for a vote to approve the rebalancing. So are there any questions before I do a motion to approve the rebalance recommendation?
Ellen is sick. She left a message in the chat. Can you please?
We're rebalancing, restating what David said, rebalancing among, we're not changing the weights within each category, we're rebalancing within the category. All right, so can I get a motion?
Moved.
Second.
Thank you. Roll call, Pamela. A vote to rebalance.
Yes. Arana Ortiz?
Yes.
Arenas?
Yes.
Val?
Yes.
Hyler? Leonard?
Yes.
And Rush?
yes.
Okay. Rebalance approved. All right, next on the agenda, Sebastian, thank you so much as always.
No
Thank
problem.
you.
Great job.
Thank you.
Very well presented. Thank you so much. All
Dave,
right,
can you go back to the agenda? Thank you.
new business. Do we have any new business? I didn't see anybody signing up for public comment. Do we have any?
Yes, we have David Vieira.
All right, thank you. All right, so calling for public comment. Can we please promote David Vieira, please?
Sorry, Evelyn, you have one item. I don't know if you're taking it up today on the agenda, which
Oh,
is
the auditor's
discussion of the
contract?
auditor's contract.
Oh, I didn't see that. Sorry. I'm sorry. I didn't see that. All right, so auditor's contract, I'm guessing it's up for renewal, so we need to do an RFP. Is that what I'm gonna hear? Is that a yes?
It's basically, just so you know, I talked to Ellen about this. It was, we typically would talk about maybe entering into a new contract with your auditing company, but with COVID, we extended the contract and it was just a matter of now that we're coming out of it, if you wanted to. So she wasn't,
Yeah, so we need
Ellen
to-
kind of explains it.
Yeah, so there's a, no voice Ellen. Put a comment in the chat. We pushed it out. We renew just for the purpose of people new in the committee. We review the service contracts, I think it's every 3 years, every 5 years, something like that. And so the auditor's contract, it's up for rebidding. So we pushed it out. It was due for rebidding because of COVID. We pushed it. So it sounds like we need to rebid. So the question is, and Ellen, you can just answer in the chat. So is the plan to then, is the recommendation to rebid the auditor's contract and launch a bid in the new year? To have a decision for the new year? For the audit for the following year?
Yeah, so the.
So do an award in the spring.
Right,
Yeah.
but even if we have a design, even if the trustees have a desire to stay with the existing firm, rebidding it and reviewing their response, I think is good business practice.
Yeah.
And we also have the option, certainly, should we choose to stay with the existing firm, of changing the individual client managers as well in order to just have fresh eyes. So there are a number of ways to approach this, but it does feel at least appropriate and responsible to begin the bidding process.
All right.
I totally agree with that approach. This would follow the same procurement process that we've done in the past, right, David? So,
Yes, we would develop the scope of work. We would put it out for bid. We can solicit individual firms that we're aware of. We would bring the recommendations through committee.
And we did interviews the last time, so we.
right. We had them come in, the finalists.
Right.
Yeah.
Yep.
So we'll be able to do that again.
Yes.
Okay.
And actually, that's something that the current auditors have done. They switch the managers around because I'm the one who talks to them, so I know they're different. So, all right, so good. So then, and it just to get it on the record, it's not, it's a bid, but it's a quality RFP. So, we go for qualitative, not based on pricing. All right, any other comments? Any questions on the bid? So we could expect then interviews sometime in the winter months, I'm guessing. All right. Anyone?
Winter into spring.
Winter into spring, yep. All right, we don't have any questions. Okay, now to public comment. My apologies, David. So do we have David promoted?
Yes, good morning.
Good
Um,
morning.
And Evelyn, don't worry, the business of the committee is as important as public comment, of which I have none this morning. So thank you very much for the meeting.
Oh, thank you, David. I was looking forward to your comment. All right, anybody else? I know we have others. All right, Alyssa, nothing else? Nobody else?
No one else signed up for public comment.
All right. Well, I appreciate everybody who joined. And we'll see each other in the trustee meeting coming up. Next
Yes.
meeting.
Next Tuesday, the 16th at 8:30.
And
Thank
this
you.
committee is not meeting again until January.
Correct.
So we'll see each other in the trustee meeting. Thank you all. Really appreciate it.
Thank you.
Thank you. Bye-bye.
Thank you. Have a
Thank
good
you.
day.
Bye-bye all.
Thank you, Jay.